Hello everyone and welcome back to our channel. In today's video, we're discussing the collapse of Silicon Valley Bank, one of the biggest names in the banking industry. For decades, Silicon Valley Bank was known for its close relationships with tech startups and its willingness to take on high-risk loans. However, in February of 2023, the bank was forced to file for bankruptcy, sending shockwaves throughout the tech industry and the broader economy. In this video, we'll explore the factors that led to Silicon Valley Bank's collapse, its broader implications for the tech industry and the economy, and what we can learn from this experience. We've looked at several sources, including CNBC, Seeking Alpha, and The Hill, to understand how this happened and what it means for the tech industry. Silicon Valley Bank's rise to prominence was fueled by its close relationships with tech startups and its willingness to take on high-risk loans. According to CNBC, the bank was founded in 1983 and had grown to become a leading lender to the tech industry, with more than 16,000 clients worldwide, including Tesla, Twitter, and Uber. However, over the years, the bank's focus began to shift. They took on more loans outside of the tech industry and continued to pursue risky lending practices. According to Seeking Alpha, the bank's problems were a result of a combination of factors. Firstly, the bank's loan portfolio was heavily weighted towards the struggling real estate market, which had been hit hard by the pandemic. Secondly, the bank had made several bad bets on high-risk loans to startups that had failed to take off. And thirdly, the bank's cost structure was too high, and they were unable to keep up with the competition. In February of 2023, Silicon Valley Bank was forced to file for bankruptcy. This was a shocking turn of events for a bank that had once been a powerhouse in the tech industry. The bank's collapse has raised concerns about the future of tech financing, as well as the broader implications for the economy. The Hill notes that the Silicon Valley Bank collapse is a reminder that the tech industry is not immune to economic downturns. This is especially important to keep in mind since many tech startups have relied on easy access to funding in recent years. Furthermore, the collapse shows that no bank is too big to fail. This could have a significant impact on investor confidence in the banking industry, especially in Silicon Valley. What can we learn from the Silicon Valley Bank collapse? Firstly, it's a wake-up call for other banks and investors to avoid taking on too much risk. Secondly, it highlights the importance of diversification in investing and lending. Thirdly, it shows that startups in the tech industry are not immune to failure, and it's essential to invest in companies with solid business models and sustainable growth plans. But the collapse of Silicon Valley Bank also has some broader implications for the tech industry. CNBC notes that Silicon Valley Bank's fall from grace could lead to a slowdown in the pace of tech innovation. With the bank's tight relationships with startups, it served as a vital source of funding for companies that were not yet profitable. This meant that these companies could take risks and invest in research and development. Without Silicon Valley Bank, it's possible that some of these companies may not have access to the same level of funding, which could slow down the pace of innovation in the industry. Furthermore, the collapse of Silicon Valley Bank could have a ripple effect on the broader economy. According to Seeking Alpha, the bank had over $100 million in assets, and its collapse could cause a chain reaction in the banking industry. This could lead to a tightening of credit conditions and a reduction in the availability of financing, which could have a negative impact on businesses and consumers. According to an article published by The Guardian, U.S. Treasury Secretary Janet Yellen has stated that there will be no bailout for Silicon Valley Bank. Speaking at a press conference, Yellen explained that while the collapse of the bank is concerning, it does not pose a systemic risk to the broader economy and therefore does not warrant a government bailout. Yellen said conditions did not match the 2008 financial crisis, when the collapse of large institutions threatened to bring down the global financial system. She also sought to calm fears the $23 trillion U.S. banking system could be affected by the fall of a regional bank. The director of the White House Office of Management and Budget, Shalanda Young, told CNN's State of the Union the situation was being taken seriously and attempted to soothe fears that regional banks might be affected. U.S. banking has a better foundation than before the financial crisis, largely due to the reforms put in place after the financial crisis, Young said, adding that reforms gave regulators more tools, and our system is more resilient and the foundation stronger because of it. In conclusion, the collapse of Silicon Valley Bank is a stark reminder of the risks associated with high-risk lending and the importance of diversification in investing. The bank's fall from grace has raised concerns about the future of tech financing, the broader implications for the economy, and the potential impact on the pace of innovation in the tech industry. However, it's also an opportunity to learn from the mistakes made and take steps to prevent similar situations from happening in the future. As investors and consumers, it's important to be aware of the risks associated with high-risk lending and to invest in companies with solid business models and sustainable growth plans. We must also ensure that the banking industry is regulated and monitored to prevent excessive risk-taking and the buildup of systemic risk. Thank you for watching, and we hope you found this video informative. If you have any comments or questions, please feel free to leave them in the comments section below. And don't forget to subscribe to our channel for more informative content.